There's this thing called the Conference Board Leading Economic Index. And this is a tool that combines 10 different pieces of economic data, like housing and jobs, into one financial model. Now, going back almost 40 years, this index has predicted a recession every single time. Typically, this index goes up and up until reaching a peak, and then 11 to 12 months after reaching the peak, a recession starts. Bad news, boys and girls, it last peaked in February of 2022, which means that as I record this video, we could be starting a recession right now. And I know that sounds scary, but this video is not meant to scare, but rather inform. I find that it is best to combat fear with facts. So in this video, we're going to talk about what this all means and what investors should do about it. Let's get started. Okay, so let's talk about what a recession even is. Most of the time, our economy gets bigger. So as people are prosperous, they spend more money, which helps businesses do well. And as those businesses do well, they hire more people, which helps more people prosper, and the cycle goes on and on. However, sometimes the economy, for various reasons, gets smaller. And that's what a recession is. It's when the economy goes backwards. Like my hairline. Look at this. Now, recessions sound scary, but they're actually quite common. And going back 120 years, there's been a recession about every 7 years. And yes, I am throwing political debate aside and I'm counting 2022. If you know, you know. So while it sounds scary, in reality, most of the people watching this video have already been through a recession 5 or 6 times in their lifetime. Okay, now I'm standing outside just so that I can reset your attention to tell you something important. Recessions are bad for profits. Look at this chart from Yardeni Research and focus on the blue line. The blue line shows operating profits for companies in the S&P 500. The shaded areas show recessions. Profits take a big hit, generally speaking, during recessions. That's a crucial point because of a truth in the stock market. Profits drive stock performance over long time periods. This other chart from Yardeni Research shows an undeniable relationship with earnings per share, or EPS, in the blue line and the stock price with the red line. Okay, so recessions hurt profits. Here's a practical example of that from Starbucks. In 2007, Starbucks generated revenue of $9.4 billion, and in 2009, it generated revenue of $9.8 billion. Now, while that was up during that time, Starbucks had opened about 1,600 new locations. So sales per location actually went down during this period known as the Great Recession. There's nothing revolutionary about this. This makes sense. As people have less disposable income because of the recession, they're more inclined to make their coffee at home. However, losing sales per location has a profound effect on a company like Starbucks. Its operating profits were essentially cut in half during this time period, even though its revenue was up on an absolute basis. Okay, so if a recession is imminent right now in 2023, does that mean that investors should sell everything that they have in stocks, get out, wait for the economy to recover before investing again? Not necessarily. Being able to predict what the economy is going to do is far easier than predicting how the stock market is going to react. And that's true for 2 reasons. One, in the short run, the stock market is run by investor emotions or sentiment, how investors are feeling about the market. And feelings are fickle, subject to change very quickly. 2, the average recession doesn't actually last very long. Going back to World War II, the average recession only lasts about 10 months. Therefore, this isn't a lot of time, and investors can quickly start feeling much more encouraged relative to where they are right now. This is something that Warren Buffett spoke to in his 2008 letter to Berkshire Hathaway shareholders. Buffett wrote, "We're certain, for example, that the economy will be in shambles throughout 2009, and for that matter, probably well beyond. But that conclusion does not tell us whether the stock market will rise or fall." Going back to 2008 and 2009, that was a period known as the Great Recession, if you can remember back that far. And Buffett was very much right. The economy was in shambles in 2009, just like my hairline is in shambles. Buffett was right about the economy. However, getting out of the market at that time would have been a terrible move. In fact, the S&P 500 went up about 26% in 2009, making it the 5th best year since the year 2000. So if you saw that the economy was going to be in shambles and then reacted by getting out of the market, that would have been devastating to your long-term finances because you would have missed one of the best runs that the market has ever had. So, what does a recession in 2023 mean for investors? To answer that question, I can't think of anyone more qualified to answer than someone who has been through more than a dozen recessions in his lifetime, and that is Warren Buffett. One of the worst recessions and one of the longest recessions that ever happened was from 1973 to 1975. During this time, OPEC had an oil embargo, and then President Nixon was trying to control wages and it didn't work well, and he took the US off the gold standard. In short, the economy was a mess. Now, during this recessionary period, Forbes actually did an article in 1974 on Warren Buffett. And in that article, Buffett said, "This is the time to start investing." Now you might think, so what? He's Warren Buffett. Isn't he always investing? He's always saying this. That's not actually true. Consider that from 1957 to 1969, Warren Buffett ran what was called the Buffett Partnership, and he did extremely well. In fact, he averaged about a 30% compound annual growth rate with his investments, which means that if you had done exactly what Warren Buffett had done, you would have turned $10,000 into almost $300,000 in just 13 years. I challenge you to find anyone who has sustained that kind of success for that long. Warren Buffett was clearly at the top of his game in 1969. However, in that year, Warren Buffett got out of the market almost completely. He believed that the stock market was overvalued, he didn't believe that he could find good things to buy, and so he sold his stocks, returned money to his partners, and he sat on the sidelines and waited. That is, he waited until the recession of 1973 to 1975, and then he jumped in and started buying, and buying very aggressively. And why was Buffett buying aggressively during that time? Simply put, he saw a lot of good bargains. He saw a lot of good stocks to invest in for the long term. So does this mean that all stocks that are down during a recession are good buys? Absolutely not. And in fact, we can use Buffett again here as an example. In 2008, during the Great Recession, Warren Buffett bought a large stake in ConocoPhillips, the oil and gas company, and he bought this stock when oil prices were near their high. Before long, oil prices came down, as did ConocoPhillips stock. And Berkshire Hathaway wound up selling its stake in ConocoPhillips because it saw better deals. And Buffett said that this investing mistake cost Berkshire Hathaway shareholders billions of dollars. So I think that's pretty much the two takeaways from this video. Yes, a recession is coming, and that is bad for the economy. However, we don't really know what the stock market is going to do, so it's important to stay invested with the stocks that we have. But second, there's very likely to be a lot of good bargains in the stock market if a recession does occur. Therefore, it is important to keep your eyes open for good deals and be ready with cash if you can. Not everything is a good buy during a recession. You still have to find good stocks to invest in. If you want to know more about that, I did do a video on it. It's not the greatest quality, but hopefully the information in it is still very useful. So click on the link here if you want to. Other than that, thank you for watching so much. I'd appreciate it if you gave a like if you found value in this video. I'd also appreciate it if you subscribed if you feel so inclined to do so, and we will see you in the next video.